Hello viewers, and welcome to the weekly macro roundup for the week ended 17th January 2026, presented by Michael Ogunremi. As always, we cover the most important developments across global macroeconomics, financial markets, and geopolitics. Let's get started. Starting with the United States. This week, the global growth narrative received a boost after the World Bank revised its global growth outlook higher, noting that the world economy has proven more resilient than expected despite a historic escalation in trade tensions. Global GDP is now projected to grow 2.6% in 2026, with the U.S. economy upgraded to 2.2% growth, reflecting stronger domestic demand, tax cuts, and real wage gains. China and India are expected to remain key growth engines, reinforcing the idea that tariff shocks are being absorbed rather than derailing the cycle. On the political front, President Trump demanded that credit card lenders cap interest rates at 10% for 1 year, arguing that the move would ease the burden on American households. However, banks and industry experts warn of unintended consequences, including tighter credit availability for riskier borrowers and higher fees elsewhere. Markets have begun pricing in regulatory uncertainty for U.S. financial stocks, particularly those exposed to consumer credit. Energy markets were also in focus. Oil prices touched their highest level since November after President Trump announced a 25% tariff on countries doing business with Iran, following a wave of unrest. The move adds another layer of geopolitical risk premium to oil markets at a time when global supply dynamics are already tight. On the data front, applications for unemployment benefits unexpectedly fell to their lowest level since November, pointing to a still resilient labor market. Core inflation remained contained, with core CPI rising 0.2% month-on-month and 2.6% year-on-year, matching a four-year low. Factory production surprised to the upside in December, suggesting U.S. manufacturing found some footing toward year-end. Federal Reserve officials maintained a cautious tone. New York Fed President John Williams stated that interest rates are well positioned to stabilize the labor market and return inflation to target. J.P. Morgan now expects the Fed to hold rates steady throughout 2026, with the next move potentially being a hike in 2027. Meanwhile, foreign holdings of U.S. Treasuries climbed to a record high, underscoring sustained global demand for U.S. duration. China remained firmly in the spotlight this week, both on policy and markets. Authorities tightened margin financing rules, raising requirements from 80% to 100%, signaling unease over a rapidly overheating equity market that has added more than $1.2 trillion in value in just 1 month. The move triggered some equity volatility, but left bond markets relatively insulated, highlighting Beijing's preference for targeted financial stability tools rather than broad tightening. At the same time, the People's Bank of China reiterated its commitment to flexible monetary easing, announcing upcoming reductions in relending rates and signaling further room for reserve requirement and interest rate cuts. New yuan loans for 2025 hit a 7-year low, underscoring weak private demand, even as December figures showed some improvement. On trade, China moved to cancel or reduce tax rebates on hundreds of products to reassure trading partners concerned about export surges. China's trade surplus reached a record $1.2 trillion in 2025, as exporters diversified away from the U.S. toward Southeast Asia and Europe. Meanwhile, China overtook the U.S. in outbound investment in the first half of last year, marking a structural shift in global capital flows. Equity sentiment remained constructive, with Goldman Sachs projecting a 20% upside for the MSCI China Index, supported by AI investment, policy initiatives, and new growth drivers, despite lingering concerns around consumption and credit demand. Turning to Europe, excluding the UK, there were some tentative signs of stabilization in Europe's largest economy, German GDP grew 0.2% in the fourth quarter, marking the country's first full-year expansion since 2022. Growth was driven largely by household and government consumption, while exports continued to suffer from U.S. tariffs, a stronger euro, and competition from China. On trade policy, the European Union is weighing minimum price mechanisms for Chinese electric vehicles, signaling a possible thaw in EU-China trade tensions even as the U.S. pushes for a harder line. Germany also floated the possibility of a landmark EU-India trade deal by the end of January, a move that could reshape global trade relationships. The European Central Bank remains firmly on hold. Governing Council members reiterated that rates are unlikely to rise this year barring unexpected shocks, as inflation remains close to target. However, warning signs are emerging in equity markets, with indicators suggesting European stocks are becoming increasingly overbought after a strong rally. Now to Canada. Canada's trade and geopolitical positioning continues to evolve amid U.S. protectionism. Prime Minister Mark Carney, upon his visit to China this week, signed agreements to ease the 100% tariffs on China's electric vehicle exports to Canada, although with quotas on volumes, while China, in return, will ease restrictions on Canadian canola. Officials, however, are tempering expectations given domestic political resistance, especially from stakeholders in Canadian auto sectors. Canada's auto manufacturing sector suffered a setback in November, with motor vehicle sales plunging nearly 16%, highlighting pressure from global supply constraints and U.S. trade tensions. At the same time, Canadian equities are outperforming, with the TSX posting its best relative performance versus U.S. stocks in 2 decades, as investors seek refuge from heightened volatility south of the border. Broader concerns are emerging in real estate, where around $30 billion in private real estate funds are now locked or under restrictions, reflecting stress in the sector. Canada is also pushing to diversify trade further, with negotiations with the United Arab Emirates set to begin next month. Finally, Japan. Japan's cross-asset divergence continues to widen. Japanese equities hit record highs, while the yen and government bonds weakened amid speculation that Prime Minister Sanai Takaichi may call a snap election. Markets are increasingly concerned that looser fiscal policy could delay consolidation and keep the yen under pressure. The Bank of Japan may raise interest rates as early as April, according to former policymakers, as Japan's economy returns to something resembling normality for the first time in decades. Household spending jumped sharply in November, rising 2.9% year-on-year, a strong upside surprise that supports the reflation narrative. This divergence, strong equities alongside weak bonds and currency, highlights Japan's unique transition phase and suggests greater volatility ahead across Japanese assets. That brings us to the end of this week's macro roundup. Looking ahead, markets will be watching U.S. inflation data, central bank signals, IMF projections, UK growth figures, and further developments in China's financial stability measures, all of which will shape near-term risk sentiment. Thank you for watching. Please remember to subscribe and turn on the notification bell, and I'll see you again next week.